Hello everyone, this is Manjula Devi P. In this session, I would like to discuss about company analysis, which is part of fundamental analysis. Actually, in the previous sessions, we have discussed about economic analysis and industry analysis, which is also part of fundamental analysis. Company analysis is basically the third step of the fundamental analysis. So, what do we do in company analysis? How do we find the competitive edge or the position of the company in the industry as well as in the whole economy is all the subject matter of this session. So, company analysis basically is a study of variables that influence the future of a firm both qualitatively and quantitatively. So, we want to know what is the future perspective of a firm. Okay. We might have analyzed the whole economy, maybe economy is doing well. We might have analyzed the whole industry, maybe industry is also very attractive and doing well. But the company in which we actually want to invest, we have to do a thorough analysis of the company also, and it's actually most important because if economy is doing well, if industry is doing well, it doesn't mean that company will also do well. So, we have to see what is the competitive edge or what is the position of the company in the entire industry as well as in the economy. So, here we check the competitive position, its earning in terms of profitability, its efficiency with which it is operating, its financial position, and what is the future perspective with regarding the earnings of its shareholders. Okay. So, what is the present position and what could be the future position, we get to know by doing the company analysis. So, what are the basic tools or the indicators that we actually look into when we do the analysis, which gives us a hint about the performance? So, basically we look into the reports which is published about the company. We look into the profit and loss account, which is also called statement of profit and loss and also income statement. Then we look into the statement of financial position, which is also called as balance sheet. Then we also see the statement of changes in equity. So, these three are the main reports. Of course, apart from this there are many other reports. We have cash flow statement, we have fund flow statement, we have directors report, auditors report. All those things will give us an idea about how the company is performing. But to get the quantitative data, we would look into these three important as well as the basic reports that the company publishes. So, what are the tools we use for doing the analysis? Of course, we have got the data, we have got the profit, we have got what was the profit of last 5 years, we got to know what is the balance sheet is talking about the assets, liabilities, about the capital. In the statement of changes in equity, it talks about what is that addition, deletion that has happened in the equity section. So, we get the data, but just getting the data is not sufficient. We have to carry out the analysis on it. For carrying out the analysis, the most common tools used are ratio analysis, we use trend analysis, we prepare comparative statements, we prepare common size statements. So, what are all these things that indicates? First one, the ratio analysis. You might have come across with ratios in earlier sessions or in any other subjects like financial accounting, financial management, even in the management accounting. So, where we usually come across with the ratios. So, there are some important ratios which are used by the investors or prospective investors for doing the analysis. First and foremost, return on investment, ROI. So, this talks about what is the return that is being generated by the company by using the invested funds. Basically, we take the operating profit and the total amount invested and we take out the percentage of it. So, higher the return on investment indicates that the operational efficiency of the company is good. Then we take PE ratio, profit earning ratio or price earning ratio also we call it as. Here basically we compare the profit with the earning per share. Okay. Even that gives the indication of how what is the earning and price ratio of the shares. Then EPS, one of the very important indicator. What is the earning that each share is actually getting? So, it talks about the profit after tax, profit after preference dividends divided by the number of equity shares. So, it gives the earning per share. More the earning means better for the investors. Then debt equity ratio. So, when you are investing in the equity position of a company, so you need to know what is the debt and equity proportion. Suppose if the debt is more, then that means there is a lot of risk involved in the company. If equity position is more, again it is not having risk position, but it will have a lot of dilution of control. So, anyway it has to be balanced in a proper way. Dividend payout ratio. So, this talks about out of the earnings how much is actually paid as dividends. Dividend yield. So, here it talks about what is the dividend you are getting on the market price of the share. Then dividend cover talks about the how many times the available earnings are available to pay the dividends. Then interest cover out of the operating profit, how many times the interest could be paid. So, more interest cover means you have more funds available for paying other returns like dividends and preference dividends apart from the interest. So, these are some of the ratios. Of course, there are a whole lot of other ratios which are actually there, and all the ratios could be calculated for checking the analysis or for checking the financial health of the company or the performance of the company based on its historical data. So, these are some of the ratios which are generally used. So, if all the ratios gives a positive indication, then we can go ahead with the investment. But not just the financial data, there are a whole lot of non-financial information which is also important when we are doing the analysis, like the business of the company, like what is basically the actual business of the company, what are the types of goods and services they are actually into. So, that is also important. Then what is the management composed of, who are the people who are there, whether those people are having good credit worthiness, good reputation in the market, or are they having, suppose if somebody is having already a criminal background, or if somebody has a financial crime background, then definitely the investors are not interested in going for it, isn't it? Because the people who are in the management also matters, their credit worthiness and their integrity, all that matters when taking the investment decision. Then what is the market share? So, out of the total sales of the industry or volume of the industry, what is this company's share? So, is it too small in the industry, or is he a market leader, or is he an average player? So, all that matters when we are investing. And the product range with which, are they dealing with only one product, or they have whole range of products. So, when they have more product range, then it is good for the company. If any product goes low, the other product can pull the market or pull the revenues. Then to what extent they are diversified? Are they into only one product or one type of products, or have they gone diversified into different sectors? So, even that matters. Expansion, to what extent they have the expansion policy, or is the volume or their operation is same as year to year, or are they going for expansion? Then do they have any foreign collaborations, when that matters? Then what is the extent of research and development? Even that is one of the very important indicator which actually decides about the growth. If they are not into much of research and development, then it is kind of stagnating the performance. So, if they are more innovative, they are getting into more research, more products, more diversification, then that means it makes it more attractive. So, just to have a quick recap of what we discussed in company analysis. So, basically in the company analysis, all the factors which affect the earning of a company is being considered. So, it involves assessing of the company's competitive position, their earning capacity, the present earning capacity, their future earning capacity can be assessed or forecasted based on the present data. Then we carry out we use many tools like ratios, comparative statement, trend analysis, common size analysis for assessing the performance. Again, along with financial data, we have whole lot of non-financial aspects which are also important for assessing the reputation of the company in the market. So, both financial and non-financial are considered for doing the analysis. So, once we are done with the economic analysis, then industry analysis, and if company analysis, if all these three analysis gives us a positive indication, then we can go ahead with investing. But we have one more set of analysis which is called technical analysis. In the next session, we will see what is the meaning of technical analysis, what are the different tools that are used while doing the technical analysis. So, these are the some of the references which you can go through for getting the concept more clear or for having a deeper knowledge about the topic that we are discussing. Thank you very much.